Hey guys, what is going on? Welcome back to the portfolio. Welcome back to the channel. Great to have everyone back on the Robinhood series. For today's video, I want to go through a quick example of why I got into options by selling covered puts and covered calls. Essentially a way of buying a stock by getting paid to do it and then selling off a stock and getting paid to do that as well. This is part of a wheel strategy, which basically you're using contracts as a substitute for buy and sell contracts. So you put in a put contract. If it does go through, you are assigned those contracts. You basically got paid to buy a stock. And likewise, if you're selling off a stock, if you do a sell contract, you're basically getting paid to sell off the stock as well. And then if you throw in any dividends that you accumulate while waiting to sell off a stock with your call options, and then also if you do make a positive swing trade from the price you bought the stock from the price you sold the stock, you basically have four ways of making money. By selling off the initial put contract, selling off the call contract, dividend income while you wait for those contracts to essentially be assigned, those sell contracts, and then any dividend income that you receive. So four ways to make income by utilizing this strategy. And this is really why I switched over to doing a lot of options contracts. I don't buy contracts. I think that's a little bit more risky. Yes, you can make quite a bit more money by doing that, but it's much more risky because you have to have the stock move in your particular direction. With this strategy, if you're more than comfortable buying the stock at a certain price, you simply put the put contract in for that price. And if you're more than comfortable for selling off a stock at a certain price, you simply put a sell contract in for that price. And you're basically doing the same thing you would normally do, but you get paid to do it. So let's go ahead and do an example of this. A stock I do not have in the portfolio, VT, Vanguard Fund, a very good overall ETF. You can see here top 10 holdings: Apple, Microsoft, Amazon, Nvidia, Google, Alphabet, that's a parent company, Tesla, ExxonMobil. So these are quality companies, and these are all contained in this ETF or exchange traded fund. And you can see over the past year of trading, it's down a bit, 9.67%, but definitely has been rebounding here in the shorter term, 3 months of 5.16%. So the way to utilize the strategy is, for example, normally if you just wanted to buy the stock, you could go trade, buy, put in 100 shares, for example, spend $9,204 to buy the stock, and then you would have that in the portfolio where you could sell off covered calls. But alternatively, you can go trade options, and then for the options, you'll simply sell off a put. So up on the top, buy, sell, call, put. If you put sell, put, you're basically doing the same thing as buying the stock, but now you'll get paid to do it. So for example, if you're comfortable buying the stock at $92, you can simply click on 92 put, sell one contract. Each contract is 100 shares. So now you'll get paid $115 to do the exact same trade that you did before. If the stock doesn't fall below $92, nothing happens. You continue to keep that premium in the account, and you can repeat this process moving forward. So if I go review, you can see at the bottom of the screen, you are agreeing to buy 100 shares of VT for $92 each before or on April 21st. That's the expiration date for this contract. If you aren't asked to buy VT by then, you'll keep your collateral, like I said, and the full $115 credit that you get to your account. So basically, you're buying the stock, but getting paid to buy the stock. So now, for example, let's say you do have that stock in the portfolio, then now you can sell a call. So you simply switch that over to call. The same thing, let's say, for example, you've already had this in the portfolio. You bought it for $92. Now you want to sell it for, let's say, $93. So you make $1 a share. Simply put that order in, sell one share, again, 100 shares per each contract. You'll make $85 by doing that contract. You know, I don't have this stock in the portfolio, so it's saying I can't do that. But let's go ahead and back out and do one that I do have in the portfolio, just as an example. Been doing covered calls with Pfizer. I do have that in the portfolio. So if we scroll down to Pfizer, you'll see this in the portfolio here. Trade options. Let's go over to sell call. Let's say I bought the stock for $40.50. I want to sell off for $41. I can continue to do this contract. These did expire. Let's see if I have these in the portfolio. Yes, it does allow me to do this contract. So now I could sell off for $41, but now I get paid to do that. I'll get paid $29 to sell off the stock at $41. And at the bottom of the screen, you can see I am agreeing to sell 100 shares of Pfizer for $41 each before or on April 6th, the expiration date of the contract. If you aren't asked to sell Pfizer by then, you'll keep your collateral and the full $29 credit. So basically, I could sell the stock from the portfolio, or I could do a contract to do that. So if I do trade, sell, I could simply sell off 100 shares as well, get that credit. But by doing it through contracts, sell contracts, I get paid to buy the stock and then also sell the stock off. And the other nice part about this is that if you are holding the stock by doing call contracts, willing to sell off at a particular price, but if those contracts are not being assigned to you, you'll still collect the premium for dividend income on the stock as well. So for example, Pfizer does pay out a dividend. I've been doing covered calls on this for quite some time, but I'm still receiving the dividend income from the stock as well. So on the bottom of the screen here, let's go ahead and open up all of the history past 30 days. You can see there's dividends as well as income for doing the sell contracts. And actually the sell contracts, for example, up on top, you have Pfizer short call roll, $8. Pfizer 42 call sell, $9. The dividend, $53.30. If I continue to scroll down, you can see I get reliable income by selling off call contracts at a price that I'm more than willing to sell the stock off for in the first place. $6, $4, another short call roll, $43, $16, and there's the dividend, again, $52. So I'm basically equaling or making more than a dividend on the stock by doing this strategy. So you put in a call contract to sell off the stock. If it does sell off, you can go ahead and then do another put contract to buy that stock back at the same price or a lower price, and you get paid to do that. So just wanted to respond to one of the viewers in the channel. Why am I doing a lot of contracts, call contracts, put contracts? That is why. Basically, by doing a put contract to get into a position, to establish a position, you get paid to do that. And then to sell off the stock at a particular price, you get paid to do that as well. If you make a positive swing trade, you make money on that trade. And then if you do hold the stock for a little bit longer term, you get the dividend income as well. So 4 ways to make money on one stock trade that ordinarily you'd simply buy the stock and then sell the stock off at a separate price. So that's why I'm doing call contracts, put contracts, a lot of options investing in the portfolio. It's been profitable so far. I talked about the end of 2022 in a couple of videos. I did have a large position of Tesla by doing this particular strategy, and I tried to get fancy and do some tax loss harvesting. Lost quite a bit of money. So I'm definitely trying to make profit back from that. I will do an updated video here, kind of going through all of the options income that I'm making per week and per month. It's quite substantial. And yes, this is not a tax advantage way of trading. I will get hit by higher taxes at the end of the year by doing this particular strategy. But the whole idea is that you hopefully will get much more income by doing this than will be penalized with the taxes, the increased taxes at the end of the year. So that is why I'm doing contracts. I hope that answers some of the questions. I know there's a couple of viewers in the channel asking why I switched over from doing a lot of dividend investing to doing a lot of contracts, a lot of options investing, selling off covered calls and selling off cash secured puts. And that is why, simply for doing that particular strategy. So let me know if you guys are doing the same thing or not, which stocks are utilizing for this strategy. A lot of the people call this the wheel strategy, by being able to do the call contract, the put contract, the positive swing trade contract, the swing trade, hopefully in the positive. But even if it's in the negative, you can still make money if it's offset by good options premium. And then holding the stock with a dividend, you also receive the dividend by doing this strategy. So just wanted to quickly go over that. With that, I'll end this video. Again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. So next video, we'll see you then.